If you already own a home and want to purchase another, you can use the equity from your existing home to make the new purchase a reality. But it's important to understand what your home equity is, and more important than that, how you can access it without selling. So let's understand what home equity is. Home equity is the difference between the market value of your property and your loan balance. So assuming you have a mortgage on your home, you take the property value, subtract the mortgage, and what's left over is your home's equity. Now, if you own your home free and clear, your entire home value is your home's equity. Now, it's important to understand your home value based on what the true value is, not something like a Zestimate that you get off Zillow. You can reach out to a real estate agent who's a specialist in your area to help get a better understanding of your home's value. You can have an appraisal done, which is going to be the most accurate to determine what your home value is. So in turn, you can determine how much equity you actually have in your property. Now, the amount of equity you have in your property can be determined by multiple things. There's different factors determining that. How much money you might have put down when you bought your property, because the more money you put down, the more equity you created in that property. Your monthly mortgage payments, as you make those payments, a portion of that payment becomes equity in your property, the portion that pays down the principal balance, because as your mortgage balance decreases, the amount of equity you have in the property increases by that same amount. If you made lump sum payments toward your principal, right? So the principal balance is what you owe on the mortgage. If you paid a lump sum toward that, every dollar of that lump sum you paid toward the principal becomes an equal amount of equity you now have in the property. Maybe you made home improvements to your property. Well, those improvements should result in a higher property value, which in turn would result in having more equity in your property. And of course, just appreciation in the home's value. Now, historically, appreciation is about 4% per year. Of course, you have spikes and you have years where that's substantially higher, especially the COVID years. We saw 20+% increases in the property values, which is an increase in the equity that you have within those properties. Now, once you've determined how much equity you have in your property, you want to be able to use that equity. So there's different strategies for using your home equity. Now, I talked about using home equity to make another purchase. Maybe you want to use it to buy another primary residence or a new primary residence, or you want to use it to buy an investment property, a rental property. Maybe you want to use it to pay off high interest debt that you might have. Now, you might hear interest rates are high right now, but they're definitely not as high as the interest rates you have on your credit cards, assuming you're past any sort of introductory 0% period on those cards. You can also use it to pull money out and create an emergency fund. Take that money, put it into the bank, take the money, invest it, actually earn interest on the money that was previously equity in your property. Those are important things, and those are different strategies you can use with the property's equity and utilizing your home equity. Now, what are the pros and cons of using your home equity? Well, a pro of using your home's equity versus touching your regular funds in your bank account or retirement account is it doesn't deplete your savings. You're now accessing funds that you couldn't touch previously without selling the property. It allows you to touch those funds with actually not having to refinance the mortgage. And I can get more into that in just a little bit. The cons of utilizing your home's equity is, well, it decreases the amount of equity you have in your home naturally, right? If it's no longer in your home because you pulled it out and now it's in your bank, well, you have less equity in your home. And if you pulled it out in the form of a mortgage of some type, whether it's an equity loan, an equity line, or just pulling cash out with a cash out refinance, and I'll talk about the details of each, well, now you have a higher monthly payment monthly because you're paying interest on that equity that you previously didn't have pulled out of your property. Now, what are the options for actually accessing your home's equity? Well, like I said, you can have a home equity loan, which is going to be a lump sum. So let's just say you have equity in your property, you want to take a $100,000 home equity loan. You'd receive $100,000 and you'd receive it as a lump sum, and you'd have a fixed payment on that amount of money you borrow. Typically, a home equity loan is going to have a fixed interest rate. That's why it is a fixed payment. And in most cases, it's a 20-year term. So it's a little bit higher payment because it's stretched out over 20 years versus 30, but you don't have to worry about the payment fluctuating month after month or anytime the rates adjust. And in most cases, you can go up to just under 90% of your home's value using a home equity loan. So it would take what you owe on your first mortgage, add it to what you're borrowing on this home equity loan, and together those two things, in most cases, can't go above 90%. Another option is that you can have a home equity line of credit, a HELOC. Now, a home equity line of credit has a variable interest rate. So you're actually gonna have a rate that can go up and down, and therefore your payment payment can go up or down based around that interest rate. What's cool about an equity line though is you only pay on what you're using, just like a credit card. You know, a credit card, if you have no balance on your card, you don't have a payment regardless of what the rate is. Same thing with an equity line. You take out your line, let's call it again for $100,000, but that money sits on this line until you actually draw from it. And you draw from it using a checking card or some sort of debit card in most cases, or what's issued to you on this equity line. And you're only going to pay on the portion that's being used. So if you have $100,000 accessible and you pull $10,000 of that, well, you're only paying interest and your payments based on the $10,000 that's being used for that period of time. Equity lines, in most cases, can have a 20-year term or a 30-year term, but they have a fixed amount of time from which you can draw funds from the equity line. So you can have a 3-year period of time, you can have a 10-year period of time. That means you can't pull money, right? More money from the equity line that you already have. You can't pull more from it after that period of time. Also, equity lines will, most cases, have a lower monthly payment for the first 10 years because they only require you to pay interest. And then after that interest only period, call it 10 years, is when you'd have to start paying back the principal on that loan. So your balance wouldn't decrease if you're only paying interest for the first 10 years, but you would have a lower payment. And after that period of time, you have to start knocking down that principal balance, typically for the remaining 10 or 20 years, depending if it's a 20-year or a 30-year term on your equity line. And just like the equity loan, it can likely go to 90% combined loan to value, which is your existing first mortgage plus whatever the amount of the equity line is combined in comparison to your property value. The third way to access your home's equity is the most traditional, and that's with a cash out refinance. So a cash out refinance means you're actually going to pay off your existing first mortgage with a new mortgage that's now for a higher amount because it includes money that you're going to receive back in the form of this new mortgage. Now, a lot of people are straying away from this option only because they might have gotten their mortgage when rates are in the 2s and 3s, and now rates are in the 6s and 7s, and they don't really see it being as advantageous as maybe going with an equity line or an equity loan option. But not everyone qualifies for one of those other options because they have different restrictions than you would have on a traditional mortgage. Now, with a traditional cash out refinance or traditional mortgage, you're going to be capped at 80% of your home's value. So you can't go to the 90%. If you need that additional money, that's where those equity line and equity loan come into play to help you get a little extra cash out. But if you can work within the 80% limits on a cash out refinance, the benefit is it'll be a 30-year mortgage if that's what you choose. It will have a fixed interest rate if that's what you choose. It's easier to predict what you're going to see on a monthly basis, and you'll only have one payment. You don't have to worry about paying your first mortgage payment and then whatever the equity line or equity loan payment is on top of that. So if you're a homeowner looking for ways to utilize your home's equity to start investing in your future, make sure to subscribe for more videos on mortgage and real estate investing, and leave a comment below if you have questions about your personal scenario. Your home's equity is a powerful tool that can truly change your financial situation, so make sure you're using it to its full potential.